In today's video, I'm going to be showing you how to trade liquidity sweeps with the RIMC order flow patterns. Let's get straight into it. So the first thing that we're going to start with is trading direction. That's one of the most important things. You need to know if you're going to be selling or you need to know if you're going to be buying the market. So this is what we use to understand direction. First of all, this whole red area at the top, this is a previous sideways range and initiation on the left-hand side of the charts. This has already printed. Range initiation is the first part of the RIMC concept. Range initiation, RI. When price pulls back into this range here in the future, this is where we look for a slowdown, for a mitigation, continuation. M is the mitigation, which is from a previous sideways range. C is the continuation phase, which is the next biggest phase in the market, which targets this low. This is the bearish order flow pattern. This repeats on a consistent basis on Euro USD. So this is what we use for our market direction. So this whole red area is a daily sideways range on the left. When prices are coming back into this area here in the future, this is where we want to look for our liquidity sweeps. It's not just about looking for liquidity sweeps everywhere on the chart. We want to look for them in the highest probability locations. So here we see a very clear swing high within the market. Prices run above that high. How did we break? We run above and we had a strong rejection of higher prices. That is creating our sweep within the market. So now we're only looking to sell the market. Why? Because we're coming from a higher time frame sell range and we had our bearish liquidity sweep, and now we're looking for continuations. So that sets up our overall direction. We only want to sell in selling markets, which means we're only going to be looking for sell setups in our selling market. So many of the time traders get caught on the wrong side of the market because they have a sell bias on the higher time frame and they start looking for buy setups on the lower time frame. You need time frames to align to create a probabilistic outcome. So higher time frame being bearish, we only look for sell setups. When our time frames align in that way, that's how we're going to create winning processes and winning setups and a winning strategy. So I'm going to go through two setups here. There is multiple setups here as well with liquidity sweeps followed by continuation to the downside here as well. But I'm just going to focus on two so you can just see the process of how we look at liquidity sweeps and how we trade them using our overall direction. So right now we are in bearish continuation structure. We can see that we have a high, a lower high, and a lower low here within the market. Most traders will look at this and say, this is a break or equal lows. Again, yep, this is a target here to the downside, equal lows. So we can look to target that to the downside. One of the most important things in current price action, because we always read current price action before we execute our trades, is understanding what the direction of the market is on the lower time frame. Remember when I said before, time frames need to align. So if we're bearish on the higher time frame, we need to look for selling setups. And to see our selling setups, we need to understand a bearish market or a bearish reversal in the market. So then we can look to pinpoint the perfect executions on our trades. So if we just look at this price action here, low to high, higher low, higher high, higher low, and current higher high. Price is in a bullish trending market. So we don't just want to sell every single time that we've run above a high, otherwise we're not going to be able to get involved in many winning trades. So what do we need to see in order to get involved in a sell setup? We need to see price running a high and not extending. So because we're in a bullish trend, this is the next high. What I want to see is price running above this high and seeing a strong rejection of higher prices. You see, when we broke above this high, we extended through. Now, if we run above this high and we don't extend, that shows price is slowing down. Then we look to the left. What do we look for? A previous sideways range, the same process that we use on the higher time frame. Range and initiation on the left here. When we pull back into this range here in the future, look for our slowdown, and then we can play the continuation phase. It's a fractal market pattern, which means you can use it on the higher time frame to understand direction, and then you can use it on the lower time frame to understand entries. This is the power of the RIMC order flow pattern. It repeats on a consistent basis. So all we want to do is look left and look for a sideways range. Yes, this is very messy. That's what we want to look for, some mess in the market. A contained low to high point with lots of up and down candles, lots of wicks, lots of rejections. That becomes our sideways range here in the market. Remember, we don't have to be perfect here. All we have to do is just identify a sideways range area when price gets here in the future, right? So a lot of traders, they'll look at these locations here and they'll be looking for the perfect reaction point from this wick that we have in here, and they'll be looking to get their stop just above the high of the wick. You don't need to trade like that, right? You can focus on just a general area and read current price action moving into this area, right? So let's just mark that on again. So this is our bearish order flow pattern here within the market. We have our high in a bullish trend, so we want to see how price delivers through this high. So we'll see if price rejects it. Here we run above this high, and we have a strong rejection here to the downside. So now this is setting up price slowing down. You see that when we're running above this high here, we're barely breaking above the high and not creating any distance within the market. This is a slowdown within price. This is exactly what we want to see to set up the next big phase of price here, which is the continuation phase down into the low. It's the same process that we had here as well. Sideways market, initiation, pull back into this range, mitigation, strong rejection, and continuation here to the downside. It's a pattern that repeats over and over again. We even have a bullish order flow pattern here, range, initiation, mitigation, continuation as we move higher, range, initiation, mitigation, continuation as we move higher. It's a bullish order flow pattern, which means it's just going to repeat consistently. But to increase the odds of the trades, we need to understand how we're running above highs and below lows. So for me, I trade sessions, I trade New York sessions. So what I'm doing is I'm looking for this setup either to happen before the session or in the session, so then I can look to trade my continuation here to the downside. So we already have direction here, and we have a slowdown within price. So all I'm doing is waiting for my session to open, and then I'm just gonna click sell, right? This is how I trade my setup here. So I wait for a bearish candle, and then I'm in on this trade here. So this is my entry candle here to the downside. Always look for a 1 to 4 risk to reward. The reason I trade 1 to 4 risk to rewards and I don't trade 1-to-1s like all of these Instagram traders that you see is because I don't care about winning every single trade. I care about making profit. So I want to make the most profit from my understanding of my overall trade idea. So if my trade ideas are in the continuation phases of the market, the mitigation and continuation, these are always going to be the biggest moves in the market. So what's the point in only taking 1-to-1 risk rewards out of the market when I know that I can capture 40 to 60 pip moves in the market? I might not win every single trade, but overall, if I win 50% of the trades, this is massively scalable and massively profitable, which is why I always use positive risk to rewards. So this is a trade I actually took. I'm going to put the entry on the screen right now so you can see it. Just following the same process here within the market, and we ended up seeing a continuation here to the downside again. Range, initiation, mitigation, continuation. The slowdown is important because we're in a bullish trend. So I want to see price slowing down because that tells me that price wants to move in the opposite direction. It's happening inside our sell range here, where we're anticipating the next phase of price in the RAMC order flow pattern, which is the continuation. And then I've got my entry candlestick confirmation, and this is happening during New York session where we know that there's an increase of volume in the market, so there's likely to be a move happening within the market. So I'm just putting myself on the side of probability, and I'm just putting myself on the side of the higher time frame direction. That's where all my winning trades comes from. So that's one setup that I got into. Let's look at another one. Okay, so now we are into the next day. We have news here. So typically I'm only going to be trading after the news. I don't trade into news. I always trade after it, right? So for me, with my strategy and how I trade this, I'm only going to be looking at price action after. But again, same process, right? What do we see? We can see that we're in this bearish trend here, this A to B. We've broken this low here to the downside as well, showing our intention for lower prices. Now, what can we see moving into our current price? Between this A to B, this is a move up, a pullback, and a continuation. So again, same process as yesterday, which means I'm going to use the same process to take a sell. Because we're in a bullish trending market and I want to sell, I'm going to wait to see price either run this high or the swing high that we have up here, and then I'm going to look for my selling opportunities in the market. This one process of seeing price running a high and not extending when we're in a bullish trend is going to massively increase your strike rate of your winners playing out overall. So this already has massively increased the winners of all the diamond traders. This is a process that I shared with the diamond traders inside NJT, and they're already taking advantage of not getting involved in shit trades, which are going to take you out a lot of the time. And also they know when to sit out of the market and when to get involved in the market as well. So it's a really good process. But playing this forward, we run above this high. And what do we have? A strong rejection of higher prices, right? This is showing what? A slowdown within price. And again, what do? We just look left. We can use that same range that we had on yesterday here in the market and play the RAMC order flow model again, right? And it's just the same thing over again. It doesn't matter that price has already reacted from this range here and seen continuation. All it's doing is creating a new low for us to target for range, and initiation is now this new low, mitigation and continuation here to the downside. Run above a high, strong rejection, shows price doesn't want to continue any higher. So now what phase of the market are we in? We're playing the continuation phase to the downside, which should target this low for the continuation. So again, this is a process that you can enter after the news, just on the bearish candle here to the downside. This is all happening during New York session, and you can target a 1 to 4 risk to reward here in the market. So again, this is a trade that I was not in, but it's a trade showing you the same process that you can repeat over and over and over again in the market. And this is what gives me opportunities to trade every single day using my 15-minute strategy during New York session. So the key things to take away from this video is trade RIMC on the higher time frame, because then you can only trade setups in that direction on the lower time frame. So if we're in a higher time frame sell range, then on the lower time frame, like the 15-minute, you're only going to be looking for sell setups. That's going to massively increase the probability of your trades playing out. Then on the lower time frame, like your 15-minute chart, if you're in a bullish trend, then you're going to wait for price to slow down into a sell range first before you look to take your sell setups in the market. Those things right there is going to increase the strike rate of your trades playing out more often, which is going to give you more winning trades, which is going to make you more profitable. Use high risk to rewards as well, because these continuation phases, as you can see, this one here, I use a 1 to 4 risk to reward, but you can see that, this ends up continuing into massive profits to the downside. I keep it at 1 to 4 because typically New York moves 40 to 60 pips. So I want to capture the most profit in the market during my session and make the most of my time. But as you can see, you can massively scale this to bigger risk to rewards if you prefer that as well. But this happens very consistently on EU. So it's just about using these setups in your higher time frame direction. And overall, that's how you're going to capture winning trades. That is how I catch all of my winning trades. Thank you very much for watching. I hope you guys enjoyed this video. Make sure you download our free RIMC PDF in the description of this video. Check out our website and our results page as well. All of our traders' results for the week is down in the description. And make sure you guys leave a like, and we'll catch you on the next video.